I think the concerns around the rally in US equities is that valuations are quite high. I think in that scenario you want to employ a trailing stop on those, and I think there's an argument to be made that maybe some stops have been hit, so I think caution is required. I think in terms of the market...
Can I hold you there? A trailing stop, so that is a sell signal potentially rather than a buy signal?
It is staying invested in the market in the areas you want to, but employing tight risk management such that you can get out, take your profits, but in the near term, stay invested in the market effectively. I think the companies that have led the market higher, of course, have been parts of the Magnificent Seven, Nvidia, and so on and so forth. I think increasingly what we're seeing is dispersion among those names, a breakdown from the Mag 7 to the Fab 4 to the M&Ms. We at Titan are employing a bit of a nuanced approach to those names. We like Amazon, we like Meta, we like Nvidia, and we continue to have positions in those. We are underweight other parts of the Magnificent Seven. We do not currently hold Tesla. So there's nuance there. But I also think, with US equities coming off the boil and tech coming off the boil as well, you have to start thinking about, well, where do we reinvest in? Where do we explore? So we like Japan. We're watching the dollar-yen exchange rate at the moment, following on from the events overnight. Yeah. But Japan continues to do well. We think Europe potentially represents a compelling opportunity in terms of attractive valuations. It was good to see Christine Lagarde come out and really differentiate the policy of the ECB from the US and others, and I think that's the right thing to do. I don't think it's going to do much for growth in 2024, but it sets the scene for a nice potential domestic rebound in 2025, as long as the growth trajectory continues. We're seeing a rotation in moving back to the US. We're seeing a rotation in US equity markets. Some of the defensive areas like utilities and defensives are doing a little bit better this month. So there's a lot of things that we're looking at, but it's a case of gradually easing rather than making large moves at this stage.
To another extent, to some part of this equity downtrend that we're seeing right now, are markets maybe making too much of the high for longer environment that we're currently sitting in, or do you think that, because when we moved the other way, markets actually went up and rallied in October last year?
Yeah, I think that we're seeing huge swings in either direction. We had the pivot towards the end of last year, 6-7 rate cuts priced in. Yeah. Those rate cuts have now largely been priced out. There's now 50-50 as to whether we get 2 in the US by the end of the year. I think you have to be aware of comments this week in the US that it's not the base case, but rate hikes are not out of the question if we see inflation continuing to rise and stickier inflation numbers. So I don't think at this point we're seeing the market overreacting the other way. I don't think the market is currently making too much of it. But our current view is that the risks are for US yields the risk is to the upside, particularly on the 10-year. The term premium is lower than the average amount, and we are seeing consistent inflation numbers coming in above expectations. So, we're more focused on the shorter end of the curve, and the yield curve continues to steepen. And I think if you were to pick up the conversation around being invested, but with a strong focus on the risks to the outlook, that steepening yield curve in the past does have repercussions on the reserve repo facility, the treasury account, the facilities, and that can lead to funding crises. So we're keeping an eye on that. It's not something at the top of our agenda.